Good Thursday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you. One more day in this crazy work week. And a great pleasure to be with my co-hosts. Around the horns we shall go. Let's start with Dwight, Millard, Highlands Mortgage. How are you, my friend?
I'm doing fantastic, John. How are you doing today?
You should be. Your rates tumbled today. My stock market tumbled and your rates tumbled. Doggone it. It's not supposed to be that way.
It's been too long coming, so
Yes.
we're hoping for more.
I hear you, brother. I hear you. Cory, Edge of Edge Related. How you doing, Big C?
I'm doing good. Doing good.
Glad to hear it. Glad to hear it. Alrighty, folks, let me tell you what we have lined up for you. We're going to get right into it because we got a lot of things to talk about. If you joined us on Tuesday, we began this topic, which is the AI world in regards to real estate, right? From home searches to mortgage approvals, artificial intelligence is absolutely reshaping how Americans buy and sell real estate. Today, we are going to continue our discussion that we started on Tuesday because we only got to a couple of our 7 points that we wanted to cover on how AI is changing the game for both buyers, sellers, and of course, Dwight's world of lending and what it means for you and your real estate transaction. So been looking forward to this, guys. Can't wait. We'll recap the, I think, 3 points that we got through on Tuesday, and then get down to our final 4 points. But it's interesting. But first, guys, let's, again, so we don't run out of time today, I'm going to get right to the stock market side of things today. You know, we've been facing a situation, you've heard us say this many times on this program. Cory just refreshed my memory that we just said it the other day. And then you even had Jamie Dimon. Remember, I joked on, I think it was Tuesday, that Jamie Dimon, the most, probably well-respected CEO of any company in the world, said the same thing we've been saying, the cockroach theory. Now, what do I mean by this? Well, we had an okay session going today. Then all of a sudden, coming across the news wires is news from the banking sector. Now, what happened? Two companies of local as well as national presence, but very local, Liens Bancorp and Western Alliance. Let me tell you what the stocks did and how it impacted the market today. Zions Bancorp down 13.14%, $7.10 loss to $46.93 a share. Western Alliance, WAL, of course, the symbol, 10.81% loss, down $8.52 to $70.32. The two companies disclosed that they were victims of fraud involving loans that were tied to funds that invest in distressed commercial real estate. This is according to Bloomberg. Zions disclosed $50 million charge-off for one of the loans, which will be reflected in the company's third quarter earnings statement. An ETF that we follow that tracks all of the banking names out there, or most of the banking names, fell 6.3% in response to that. Mr. Edge, you had a few points that you wanted to mention about this story.
Well, we talked about it a couple of weeks ago. So you had these two big bankruptcies in the car world, auto parts, and I think what car dealership, if I remember right. Lenders, yep.
Subprime lenders, yep.
Yeah, that's an interesting story in itself because their biggest client were illegal aliens. So I mean, you kind of figured that one might go bust on you. Anyway, so the big auto brands it's a huge bankruptcy, and so when the creditors got in there a couple weeks ago to start figuring all this stuff out, turns out there's billions and billions of dollars of off-balance sheet private debt. And they're getting debt on their accounts receivable, they're getting debt on everything, but they're doing it multiple times. You alluded to it on Tuesday. If I have an accounts receivable and I'm going to lever it up and get, $1 billion or 500, whatever I'm going to get on it. Well, they were doing that to multiple lenders. So multiple lenders were lending on it because it's outside the norm. It's the private credit markets. And to me, I just listen to it in the background and look at it a little bit, but the private credit markets they've been talking about a lot and how big they are. Nobody really knows how big they are or where the tentacles go. To me, looking at it from a global aspect of it, you need the private credit markets because the traditional credit markets are so tight and the interest is high.
Yes, that is correct.
So it's
and it's a lucrative niche. I mean, let's be honest. Wall Street's not going to do anything that's not lucrative. It's a very lucrative niche for them.
It's lucrative because you can charge crazy rates, but the fact that you need it points to the fact that there's something not really great going on in the overall economy, in my opinion, because otherwise these people wouldn't go there and pay those crazy rates.
Well, let's be careful on that point. Let's go back to Tricor. I'm just going to kind of call them a hard money. When I was in the auto lending business, we had other names that I can't say on the air, but let's call them kind of a hard money lender. And you hit it right on the head, Cory. And I'm sorry to interrupt you on this. They lent their prime market were illegal aliens, right? They didn't care, and they would charge interest rates commensurate with the risk that they felt they were taking. So what my point of bringing this up and rudely interrupting you is that was their target market, and that's what we have to watch, right? When you start talking about private credit, and let's kind of take everybody behind the scenes a little bit, because I'm going to go back to my GMAC days, right? My first real job I ever had out of high school, and or I mean out of college, and so on and so forth. And GMAC at that point, this was late '80s, late '80s when I was there for 5 years. They were the largest borrower of the Federal Reserve, right? So they would go right to the Fed and borrow the money and then lend it out, in auto loans, right? But did they, because I was a credit manager, I was responsible, my final position, of approving loans, right? Dwight talks all the time about automated underwriting. We just started to get into that at that point. A lot of it was still done manually. So yeah, you would look at it, it's, a dealership would fax over in those days. They'd fax over the auto deal, and you'd look at it. Of course, you'd pull the person's credit, like Dwight is so good at doing. You have to look beyond just what the credit score is. Is this somebody that's responsible, or do you want to lend on the money or not? If the answer is no, great, you pass on the deal. And they would go to a company like a Tricor, not so much again one that focused on illegal aliens, but more so one that kind of handled the subprime market. So these guys look at it, but to your point, Cory, they're backed. What do? They get their money from Wall Street. Wall Street goes, hey, Dwight, you're a subprime lender to, in the auto industry. So guess what? We're going to, your wholesale line of credit's going to be at, whatever, meaning your cost of money, 9-10%. Dwight goes, hey, no problem, because I'm going to go charge, Joe Blow, who's a subprime borrower. I'm going to charge him 20%, and I'm going to make a 10-point spread. And hey, everybody's happy. He got a car. We're making a bunch of money. Until, Cory, like you just said, something like this happens. So continue.
Well, and it rolls up. And again, back to the auto part dealer, you had a big bank, Jeffries, that had a bunch of money invested in there. And the way they do it is they have a separate kind of entity, if you will, on their balance sheet that shows this investment, but they're getting even that money from other banks. So as we've talked about multiple times, you don't know where the tentacles go because you're not sure where all the money's starting in. But this is how it starts unraveling itself, because I think even JP Morgan and some of them called for redemptions from Jeffrey, saying, hey, give us our money back while we know you still have some.
Yep.
Before this thing gets out of hands.
Yep, exactly. I would like to I'd like to take just a moment, guys, and I want to read to you, because Bloomberg kind of broke this story, if I remember correctly, so I want to give them the full credit of it. Let me read you this very quick story from Bloomberg so everybody can understand. And then the reason we're doing this, again, this brought the market down. We lost 301 on the Dow, down 107 on the NASDAQ, and a 42-point loss on the S&P 500. Not significant numbers by any means, but as we've been warning for weeks, actually probably months, the cockroach theory. This is what we have to be cognizant about as investors, portfolio managers like myself, and that is, where there's one problem lurking, there could be many more. Exactly to Cory's point, which is we don't know where the tentacles go, right? We don't know, because this is the way Wall Street works, folks. Let's say Cory, myself, and Dwight, let's say we're three major Wall Street firms. Well, it's just like the world of insurance, right? When you hear the Allstates, the State Farms, the Farmers of the world crying the blues when there's a major disaster, like, oh my God, we're writing checks for billions of dollars and so on. Okay, hold on a second. You reinsured, meaning you have other insurance companies that are also paying, and that's the way Wall Street works. It's like one company lends to another, who lends to another, who lends to another. You've got all these hands, or to Cory's point, tentacles that are involved in the deals. And that's why you have to be careful when, and I want to give kudos to Cory. The last couple of days we've been talking about, the Tricor situation, that again, that subprime lender, and then the other situation with the auto parts company, their name's escaping, First Brands, that's what it is. Because again, these guys are all intertwined together. So let me see if I can get through this story real quick before we go to break, and then we'll continue on, because again, this feeds right into the market action today. So this is according to Bloomberg. So listen closely. Shares of two regional banks tumbled Thursday after the company said they were the victims of fraud on loans to funds that invest in distressed commercial real estate, fueling concerns that more cracks are emerging in the credit markets. Zions Bancorp sank 12% after it disclosed a $50 million charge-off for a loan underwritten by its wholly owned subsidiary, California Bank and Trust in San Diego. Okay, keep this in mind. 50 million. I'm going to look at the balance sheet of Zions. I don't think that's a significant number, but again, this is a subsidiary that lent the money. Western Alliance Bancorp, also a stock of local or company of local and national presence, tumbled almost 11% after they said it made loans to the same borrowers. Okay, I'm going to stop there because I can't get through the rest of this. So now you have Zions and you have Western Alliance Bancorp all of a sudden realizing We just lent money to the same people. Now, what could be a problem with that? You'll find out when we come back. Let's turn it over to Kristen Snow, Right Now Traffic Center. Hello, Kristen. Welcome back to the Jon Sanchez Show on News Talk 780 KOH with Cory Edge of Edge Realty, Dwight Millard of Highlands Mortgage. Once again, we lost 301 on the Dow, and NASDAQ gave up 108, and the S&P down 42. Let's get the commodity side and the bonds, Dwight, and then we're going to come back to one of the driving factors. There was a number of things that happened today, but this kind of was the nail in the coffin that drove us down. The story that we're just starting to share with you in regards to Zions Bank Corp and Western Alliance. Oil pulled back pretty sharply today. $1.25 loss, $57.03 a barrel. Man, that's going to feel good at the pump if that holds. Gold continuing its run, $100.70 gain, $4,305.50. And Mr. Millard, as I said at the beginning of the show, you got to be smiling, brother. 7 basis point loss on the 10-year. You broke 4%, 3.98%.
Amen.
Finally. How do you beat that, brother? How do you beat that?
You can't. Well, you take it while you get it, right? So, I mean, the good news is, John, is as of Thursday, the 30-year fixed, according to Mortgage News Daily, is 6.23. So that's a 10 basis points improvement just from Tuesday. So from yesterday and today, your 15-year 5.8, your 30-year FHA 5.98. So you broke that 6% barrier, and your VA is at 5.99. I mean, these are just, but John, I got to tell you, since Tuesday in my travels, it's no longer the rate anymore, believe it or not. I mean, people are worried about their jobs. They're worried about they're worried about other economic issues, cost of living, things like that. So, I mean, yes, the rate's going to help. I'm not, I denied that a long time ago, and you guys corrected me. But,
let's just say it's a combination.
It's a combination.
Right?
So, but what I'm saying is
the main driver.
The rate, the importance on the rate has kind of, done this, and other items of concern have taken over. So we'll take it, but it'll be interesting to see. I wouldn't be overly surprised if you even dropped inside of 6 and we just didn't see the app. I mean, you're going to see a little bit of application, or a little bit of increase in applications, but I don't know if it would be off the charts. Because of other factors lurking out.
Other factors, right? Well, as long as this government stays shut down, it seems like the bond traders like bringing these rates down because again, that 10-year breaking 3 or 4%, and haven't seen that in a long time. All right. Well, that's great news, Dwight. Thank you for bringing us up to date on the mortgage side. Let's get back to our story from Bloomberg. Once again, if you just joined us, mid-session today, some breaking news came out. Again, the 2 stocks of local as well as national presence. I know many of you probably have banking relationships with these companies. Don't fret. As the boys and I were talking about during the break, this really is just somewhat of a drop in the bucket as if you look at the overall value of their companies. But we're talking about Zions Bank Corp. Again, stock sinking nearly 12%. They disclose a $50 million charge off for a loan that was underwritten by a wholly owned subsidiary of the company that is called California Bank and Trust. That's located in San Diego. Western Alliance Bank Corp tumbling almost 11% after they said they made loans to the same borrowers. Now, just to put this in perspective, folks, let's stop real quick. So Zions Bank Corp, again, they disclosed they're going to charge off $50 million in their next quarterly report. The market cap of the company, $6.92 billion. 50 million. Okay. It's a slap on the hand from Wall Street, as far as earnings per share. But in the big scheme of things, by no means, please don't make a run on the bank or anything else. Our biggest concern is more of these situations can begin to unravel, as we keep saying, the cockroach theory, where there's one, there's more. This could be the beginning of it. And we're, again, not alone. Jamie Dimon the other day said the same thing. Okay, so let's get back to this story. Now, once again, I'm going to read this over one more time. The disclosure, disclosure adds to the other recent loan blowups, as we were touching on earlier, including subprime auto lender Tricor Holdings, which filed for bankruptcy last month and triggered a near total wipeout on some debt. That was followed by the bankruptcy of auto parts supplier First Brand. Those of you that don't know First Brand, their products. Fram Auto Filters is one of them. I mean, a lot of name brands that many of you probably purchase and parts for your car. JP Morgan and Fifth Third Bank Corp disclosed hundreds of millions of dollars in combined losses tied to Tricolor. That's the auto lender, while Jefferies Financial Group disclosed exposure to First Brands. Now, while those hits can be easily absorbed by the biggest U.S. banks, the totals are more worrisome for regional lenders. Quote, if JP Morgan has a loan problem with Tricolor, it's puny, according to Mike Mayo, a very well-respected Wall Street analyst over at Wells Fargo. He said in an interview. But if smaller banks have problems with these loans, it takes more of a hit. Liens said in a lawsuit that California Bank and Trust is owed the money from two investments tied to Andrew Stupin and Gerald Marcel, among other parties. California Bank and Trust provided two revolving credit facilities to the borrowers in 2016 and 2017, totaling more than $60 million to finance the purchase of distressed commercial real estate mortgage loans, according to the lawsuit. The terms gave the bank, quote, first priority, perfected security interest in all collateral, including each mortgage loan purchased by the investment funds. Cory or Dwight, whatever one of you want to jump in, explain to the audience first priority, perfected security interest in all collateral, including each mortgage loan purchase. What does that mean in English?
I mean, if it's true, that means you're first in line. So you're the first deed of trust holder, the first lender on that property. So if you go through bankruptcy, foreclosure, whatever, there's no other loans in front of you. Sometimes that gets changed, John, just sort of the IRS can jump them, local taxes can jump them. If you go into bankruptcy, you get what's called DIP financing, debtor in possession. That jumps in front. So there's some stuff that can jump in front, but it's good if you have a first position.
John, I got a question though. I mean, when you start saying that this was a lender that dealt in distressed properties, right? I mean, okay, so you already now know you've got. Now you already know you got a problem. Mm-hmm. Generally, when you make terms to those type of things, it's usually higher percentage rates, higher point. I mean, you just stick it to them even worse than what they had. So, I mean, sometimes you kind of know the devil you're dancing with, don't you?
That's the point I'm trying to get across. Yeah.
But here's the thing to remember in these, because I've looked at these guys, they were buying distressed assets. They weren't technically distressed themselves. That was their business, was buying distressed stuff. So from the bank's perspective, it looked good. But I think I mentioned to you guys, we talked on air, I was with a guy 3 months ago, I think, big property owner down in the LA area, multiple malls, owns this stuff. And he told me, we had a very frank conversation. He goes, I've got maybe 2 years, 18 months right around there. That is as long as I can keep doing what I'm doing before all my stuff goes back to the bank, because I'm not making any money. My stuff, I'm dipping into other stuff to keep these things alive. And to me, that's the cockroach, right? Like that's, if a little old me had a conversation with a huge guy saying that, it's happening everywhere. So it goes back to these interest rates, and they can't refinance out of this high interest debt.
And that's the key. I'm glad you brought that up. As we've been saying, we warned 2 years ago, right? 2025, 2026 is supposed to be, or it was supposed to be the year we started to see very large commercial loan defaults, because interest rates just are not coming down. You hit it right on the head. All right, let me continue very quickly. But after an investigation, the lender, doesn't say which lender, the lender found that many of the notes and underlying properties were transferred to other entities. And those properties have already been foreclosed on or were about to be, according to the lawsuit. Cory,
that means you don't have a first debt position.
Yeah,
So here's my question. How does a bank that has first lien priority, perfected security interest, how do they not know that, ABC property that they had this on has been transferred somewhere else?
Well, they may or may not know that it's transferred, but it's, and Dwight and I've talked about this before. I have a mortgage. Technically, there's a due on sale clause. If I transfer it to Dwight, I have to pay. But as long as I keep making the payments, nobody asks any questions.
Right.
And so that's the same thing that goes on. But that's where, and again, I'm just theorizing here. They transfer to a different entity. They go into these private loan markets. Those guys have a whole different set of rules. They may loan on that. They may do all kinds of stuff, and it muddies up the water. But again, it goes back to my point of there's such high interest rates, they cannot service the debt. So they have to go to the private markets to get more capital just to service the debt on the original stuff plus the new stuff. And it's a hamster wheel. It's going to run out of grease soon.
Almost a Ponzi scheme in a sense. Not saying this deal is, but it's what you're describing.
Cory, is it similar to like a wraparound type of financing in the commercial world? If you have property, like you said, in the single family world, I could sell my house to John. He takes on, as long as I'm making the payment. Yes, it's due and payable, but is that what they're kind of doing? They're kind of just shifting the burden.
But they're going to get notified, right? If you're with,
I don't know. Not if you're making your payment. You're not.
Come on, they don't get notified when there's a title change.
No.
Really?
Well, on big commercial loans, potentially, and it's in your covenants that you can't do that.
It's due on sale.
But they have
notifies me if my ranch insurance, right? I've got all these different.
Well, that's different. Insurance is different.
Well, okay, but that to me, it's like, wait a minute, you're telling me that these massive financial institutions don't have some type of an alert
Yeah.
system when a property sells and they're not, I
No,
mean, holy
It's not
moly.
even it's more
I,
of a transfer, and it's a wraparound. We dealt with this
no,
in
it's
the
it's
08,
it's
09.
it's 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 not a wraparound mortgage. So when you transfer the title, the bank says, "Well, we don't care who owns it because we have a first lien. Like you can give
they
it to
should care.
Blue."
What if the guy that's bought a credit flake?
No, it doesn't matter though. They have a first lien, so
Yeah,
their
well,
leverage is they can foreclose on the property. But in what you just said, and I'll have to look at it more, if they transferred it and then that other lender already foreclosed, then something now you have title
Broke
issues.
down.
Like
right, right.
there's massive lawsuits happening, I'm sure.
Yes,
But yes,
for
to a normal bank, if they have a first lien position, you can transfer it to 1,000 different people. They still have the first right of priority.
yeah,
They don't
yeah.
care who owns it.
Crazy. We wonder why we get in trouble, right? Some of the things that are most common sense, you're like, I'm in shock what you guys just said. Crazy. Well, I want to continue this story, then we'll get to our topic because this is, again, very important. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hey, welcome back to the Jon Sanchez Show on News Talk 780 KOH with Cory Edge of Edge Realty, Dwight Millard of Highlands Mortgage. Once again, we lost 301 on the Dow, down 108 on the NASDAQ, and a 42-point decline on the S&P 500. Many of those losses driven by the story we're sharing with you, where Zions Bancorp and Western Alliance indicating, Zion said we're going to take a $50 million write-off because of a bad loan. Now to the rest of this Bloomberg story, then we'll get to our topic, how AI is reshaping real estate. So here's what Western Alliance happened. Okay, so Western Alliance also lent money to the same investor group for them to originate or buy mortgage loans, according to the bank's lawsuit filed in August. The outstanding loan balance with Alliance was 98.6 million. So you got 98.6 there, 60 for Alliance. Okay. Western Alliance found that the collateral was supposed to be backed by a first priority lien, but that wasn't the case. It alleged the borrower created fake title policies by omitting the senior liens. All right, boys, how the heck does that happen?
Fraud.
Yeah.
Fraud. I mean, I would assume, again, we don't have all the details. I would
No.
assume there's other people involved, maybe even at the title companies.
Yeah.
That's what I was thinking,
Yeah,
like an
which,
inside job, right?
as bad as it sounds, it
Now
happens sometimes.
here's a big lapse. Listen to this, guys. At the same time, the borrower drained funds from accounts that acted as additional collateral, according to the lawsuit. As of August 18th, the borrower, doesn't say which gentleman, the borrower held a little over $1,000 in their bank account at Western Alliance, while the required monthly average was $2 million, according to the lawsuit. So there's another bank failure, right, guys? How do you not have an alert to whomever's
Your
in
bank
charge of these
account.
loans?
Yeah.
Yeah, that you're supposed to have 2 million average balance and you have $1,000. Western Alliance also has exposure to First Brands, but said it does not expect to issue a change to its 2025 outlook. There's been a number of one-off credit events that a number of banks have previewed going into the quarter, said Terry McAvoy of an analyst at Stephens and Corp. He said in an interview, he says they've not gone unnoticed by bank investors. Keep in mind, folks, to wrap this up, then we'll move on. Wall Street pays a lot of attention to the financial sector, right? It's like the technology side. We look at it as a barometer, right? It makes a lot of sense. If banks are healthy, that means they're lending, people are depositing money, on and on and on. If the sector starts to falter, that gets everybody's hair on the back of their neck raising up, going, uh-oh, is there problems in the economy? Large loan defaults and so on and so forth. So again, I think this was, pretty much overblown, right? Very typical for something, but again, Zion's lost about 13% today, 12.96, down about $7 to 47.03. That includes a little after hours action also. But
John, what's amazing about this whole thing is the banks are still licking their wounds from 08, 09. I mean, Wells Fargo still really isn't back in the mortgage. I mean, they're threatening now to come back into the mortgage world.
Yeah.
But you're right. These things just.
Yeah, I know. Like we were joking off the air. Investors, or not investors, but banks, Wall Street, etc., they just never learn. There's just they look at it. There's too much money to be made, and again, one goes bad out of 100. Not bad odds.
It's the cost of doing business.
Cost of doing business. You got it. It's what they pay all those big lawyers for. All right, guys, let's go back to our story that we started, our topic that we started last Tuesday, right? How AI is affecting real estate investors, from buyers, sellers, and everything in between. So to recap, we said AI is powering property searches. Cory went on to explain, again, that's been around for a few years now, like Zillow and Redfin, et cetera, how that uses AI to predict the value of your property. Second point we mentioned was the smart pricing and predictive analytics. Again, Cory was talking about how it can go in and analyze market trends, neighborhood growth, comp sales to help people like Cory help determine price values, et cetera. Are you using AI much, Cory? Or are you just going off your years of experience when you're pricing a house to list?
Is that a joke?
Hey, he surprised me with some of his technology.
Yeah, no,
Get off his back.
no.
It's artificial non-intelligence. That's what I mean. Which is missing. But I do so I still run comps the way I've always done it, but I do check them against the online comps just to make sure. And again, because I know my clients are looking at that and looking at it as gospel, so I want to make sure we're somewhat close. And if we're not, hopefully I can explain why.
Okay.
Okay. And go from there.
Perfect. Let's go
Thanks,
quickly.
Dwight.
Point number 3, virtual tours and AI staging. This one is fascinating.
This one, we've talked about this a little bit. So the virtual tours is pretty easy now. And there's a distinction now on our listings where we can load virtual tours. You can do stuff. We get every once in a while on a listing, I'll get a call from another realtor that sets up a showing, but they set up a virtual showing. So they've got their client on the other end of their phone, recorder, whatever they're walking through with. And they'll go through like a normal showing. The virtual staging is pretty cool. If you haven't seen a house that does it yet or done it yourself, usually always vacant. Well, not always. Most of the time they're vacant houses, but it doesn't have to be. But you take pictures with any good camera. You can upload them to these sites. And then usually I let my client do it if they want to. They can choose what style they want it staged in. And there's hundreds of different styles. And it takes them, everybody's different. It used to take 1 or 2 days. Maybe it's not as slow now to get the images back to you. But you look at them and it's pretty amazing what it looks like. What we have to do on our side, though, is we have to put virtually staged on the pictures because otherwise the buyer shows up and goes, hey, wait a minute here. This isn't a Porsche. This is a Volvo. Yeah.
Yeah, right. Exactly. Yeah, that's a good point.
But I'll tell a real quick story. I had a client 2 years ago. The house wasn't selling. We did open houses, nothing. It was vacant. He goes, just try the virtual staging. I don't know if that's what did it or not, but we were in escrow a couple of days later and closed escrow.
No
So
kidding. I love it.
who knows? But it is a cool feature.
That is. I love that. Dwight, squeeze this last one in before we go to break. The mortgage pre-approval, literally in minutes. Right?
Yeah, we're already there. I mean, you and I had an off-air conversation about the dying breed of a loan officer, but yeah, I mean, it's probably not too far away with all the technology to just with your social security number to bring in your bank accounts, your employment, things like that. So
right.
We'll see.
Squeeze in number 5, Dwight. The fraud detection risk analysis. Really, either one of you could talk on this, but how AI is spotting the red flags in documents, loan documents, and I'm sure supporting documents people are giving you, right?
Yep.
For you to help qualify them for a loan.
Yeah, it's already on the backside. Fannie and Freddie and FHA are already it's integrity. Just that they're wanting to make sure that you are looking at these files. But yeah, it's scrubbing them on the backside, making sure you've. It's quite amazing. It can detect it's not your appraisal. I mean, that for that property, it's
fascinating.
Yeah.
All right, when we come back, Dwight's going to wrap up point number 6, which is the customized loan options due to AI, and then Cory will just give us a summary of where this is going and AI and real estate. Let's wrap it up, speaking of which, with the wonderful Kristen Snow. You don't sound too busy today. Are you praying for a snowstorm or something, or what's going on? No. Okay, don't jinx. Welcome back to the Jon Sanchez Show on News Talk 7 KOH. Mr. Millard, your phone number, sir.
Yes, sir.
Thank you, Mr. Edge. Thank you, sir. All right, we're going to wrap up our topic, how AI is reshaping real estate. So, Dwight, let's go to number 6, the customized loan options. Algorithms matching borrowers with loan programs. I mean, like you said before, that's how Rocket and all these came together. But there's something deeper that's going on that I want you to share, this thing called the Day One Certainty program.
Yeah. Well, so the customized loan option, it's already there. I mean, you could go into AI right now and say, this is your parameters. I got this credit score, this, that. Then it'll give you recommendations of lenders that participate in that field. So your cookie cutter, Fannie, Freddie, FHA, VA, those type of things, they run off the desktop underwriting LP. These are the automated underwriting systems. We now have banks, employers, all that participate in this portal that actually gets instantaneous verification of employment based upon their participation in this portal. You get your bank records. We get everything. We get your credit, your bank. If everything comes together, I'll have your file verified in, I don't know, an hour. So yeah, and that's the not the that's the vanilla version, but the customized, yeah. But there's all sorts of things now, John. Bank statement loans, I-10 loans. I mean, you name it. 1099 loans. I mean, there's every type of loan out there now. Which
Okay, but
scares
let's go
me
back.
because we've seen this before.
Yeah. Well,
Yeah.
let's go back to you're saying something, and maybe I misunderstood, that a borrower could go directly to Fannie or
Not
Freddie
yet.
now.
Not yet.
Not yet. Okay, but
Not
you think
yet.
that's what's
But
coming?
I'm just, yeah, we were talking off air. I mean, why not? I mean, I don't know why they're not. And you'll need an underwriter slash processor or something to do all the final touches.
You
I
will or
mean,
you won't need that person.
you'll eventually need an underwriter to sign off. Yes. But can you
Really?
see the
You think so?
employment base? I mean,
You
I
think
got to
so?
go be an underwriter.
Why are you so certain you need an underwriter? I challenge you.
Well, because they have a certain designation on these FHA. You might be right. I think that you would need them for a while, but eventually they might go away too, right?
So you could see the whole loan process literally boil down to a couple hours. Gee whiz, amazing. How'd you like that, Cory? You
I
list the
mean,
house. I mean, wrap us up. Yeah, what's next, Cory? I mean,
it's fascinating. If you're going to approve somebody in a half hour, why are we still taking 45 days to close? But that's a different show.
give
But
AI time.
like, it's going to change my industry with contracts and showings and stuff like we talked about.
Yes.
But what you guys are talking about right now, to me, that's a massive, massive game changer. And like Dwight was mentioning on air and off air, a lot of it's already here. It's kind of already happening. So it's very interesting.
Dwight, we got 60 seconds. Give me a 30-second answer. Then I'm going to ask Cory, where do you see AI taking your lending industry in the next year to 2 years?
Well, I think it just could be consumer direct. The consumer will be able to just go right on to what we were talking about. It'll be able to tap into just about everything you need, and you'll submit it. They'll verify it. They'll scan it. It's amazing what AI can read and on your documents already. They're doing it already. So,
Okay.
yeah.
Cory, 30 seconds. Where's your industry going with AI?
I think that'll be a big game changer for us on the loan side. You're still going to need people, but maybe the title side of it will change a lot. We'll do another show on tokenization and how you can start, not now, but eventually I think these titles will go to the tokenization, be on the blockchain, very simple transfer. So Dwight can approve them in a half hour. We can transfer the property in 10 minutes. This whole thing takes,
Half a day.
less than lunch. Yeah.
Move in a day. There you go.
Yep. Exactly.
Fascinating, boys. Excellent job for these last 2 days. Sure appreciate you. We'll do it again tomorrow on the Jon Sanchez Show. God bless. Have a great afternoon.